Hey, good day, everyone. Bert Salazar here. Welcome to the Cambridge world and welcome to our tax-free retirement life. We do these webinars on a weekly basis, so we're very, very excited. We're actually receiving quite a few emails and very good feedback from many of you that come and join us on these webinars. As you all know, we do webinars, we do podcasts, we do seminars. We're always providing education because, we are a firm that feel very strongly that information without education always leads to failure. And, I have been in the industry for 28 years. We do primarily tax planning. We do insurance and risk management services here at Cambridge. And last but not least, we handle alternative investments and life settlements and property acquisition programs. So we have a tremendous amount of knowledge when it comes to tax planning, investments, and retirement. Our number one goal in working with our clients is to make certain that they are able to acquire a tax-free retirement life, which is not an easy thing to do, but that's our specialty and we're very proud of it. So what we're going to do today is we're going to take a few minutes of your time and we're going to share with you, I'm going to share with you some of the techniques and some of the things that we pay attention to when it comes to retirement planning. When you have a discussion with anyone regarding retirement planning and retirement distribution, one of the things that we try to make certain is that our clients understand that there's a big difference between putting money away toward retirement and achieving retirement success. A lot of things come into play. It's not only how much money do you put away on an annual basis, where are you investing your money on an annual basis, what type of a risk are you and your family taking in your retirement planning. One of the things that we try to convey to our clients is that if you don't know how much money you're going to be receiving in retirement, then you really don't have a retirement plan. And some of those things are things that are very critical to us. The other thing is the vast majority of our clients are married. So we have to deal not only to making certain that they maintain their standard of living through retirement, but most important that they have enough money so their money is not going to die before they do. Because if getting old is bad, getting old and being totally broke is even worse. And most important is not only maintaining your standard of living, but also maintaining the standard of living, for that surviving spouse that is going to be left at the very end, and hopefully until he or she passes on. So there's a lot of stuff. Today we're not going to deal with many of those things. We're going to deal primarily with tax planning. But please bear in mind that when it comes to retirement distribution planning, and you have to consider the distribution rate as opposed to the accumulation rate. While you're planning for retirement, the accumulation rate is very important. What kind of rate of return am I going to get in your investments? When it comes to your retirement years, the distribution rate is going to be paramount to making certain that you will succeed and you will win the retirement game. What I'm going to do with you today is I'm going to share with you a tax planning software that we use with all our clients at Cambridge. Not only do we use it with our existing clients every single year as we do tax planning and retirement reviews, but for each and every one of our new clients, we make certain that we do this at the very, very beginning, so then we can keep track of all the benefits and all the changes that we make along the way to share where they're going to be in the future. Now, one of the big differences that we have here at Cambridge, before I get started, is that the majority of our competitors, whether they're financial advisors or financial consultants or financial strategists, as we are here at Cambridge, or even CPAs, is that they're always looking in the rearview mirror. If you're doing tax planning for a client, you come in to see your CPA, your accountant, or your tax preparer, and you're going to bring all the stuff, all your W-2s, your 1099s, your expenses, and then you're hopefully either not going to have to pay anything back to the IRS in taxes, or you're going to get some kind of a refund. I don't know which one of the two is worse. Obviously, getting a refund is pretty bad from a business and economic perspective. But we at Cambridge, not only do we do that and have the ability to do that, but we also like to look forward. We like to do tax forward planning to make certain that our clients can reduce the amount of taxes that they pay throughout their retirement life. And in many times, if we have enough time, we have the ability to pretty much divorce the IRS in retirement, and we do that legally. So what I'm going to do right now is I'm going to shut down my video. I'll bring it back up again at the end of this short webinar. But what I like to do is I'm going to stop my video at this point in time, so that way we have a much better connection with all of you. And I am now going to share my screen, which you will see in a couple of seconds there. There you go. Okay, perfect. All right, so you're gonna be watching a case that I put together. This is an actual client that I started working with a few years ago, and this is Mr. and Mrs. Morris. Obviously, because these are actual clients, I had to change the names in order to make certain that we protect our clients. We do sign with each and every one of our clients a confidentiality agreement. And we do that in order to protect our clients, because we want to make certain that anything that our clients and our firm discuss is totally held in 100% confidentiality. Now, the vast majority of our competitors in the marketplace will tell you that everything that you discuss with them is held in strict confidence, but none of them, or very few of them, would be willing to sign a confidentiality agreement, and we have no problem whatsoever in doing that. As a matter of fact, we don't engage any new clients unless they sign a confidentiality agreement, because we want to make certain that they're protected and that we are protected in the type of work that we do. All right, so John Morris and Mary Morris, they were born in 1952, so they're already in retirement. I'm using the 2018 tax year because of the new tax laws. I'm going to be sharing some information along those lines. They're married, they're filing jointly, and obviously they're in retirement, but they have not taken any Social Security. They have not taken any Social Security because, according to them, they don't want to increase their tax liability. And the second thing is they want to allow their Social Security benefits to continue to grow so they can maximize on that Social Security benefit at some point in time in the future. Now, bear in mind that whenever we do Social Security calculation for our clients, we pay a lot of attention to a number of issues that the vast majority, or the majority of my clients, don't pay attention to. Longevity. How long are they planning to live? How healthy are they? Obviously, you may have longevity on your side of the house or your side of the family, where you may have your grandparents or your mother and father that either are still alive or they lived a long life. Well, obviously, the type of planning you're going to do is totally different than if you don't have longevity on your side of the family. Also, how healthy are the parents, and how much income are they generating in retirement, where the income is going to come from. So I'm going to walk you through an exercise that I think is going to share with you something that is very critical. And what I do want to share with you, the one takeaway that I would love for all of you to take with you in this webinar, is that in retirement, not all income is created equal. So I'm going to share that with you right away. So in this situation, we have a client that they have income sources, and primarily they're generating $50,000 of income in retirement. And that income is primarily based on the fact that they are now receiving their IRA distribution and so forth. Now, the type of planning I did for this client, and these clients I've been working with for about 7 years, the type of planning I did for these clients is I created a lot of tax-free retirement income planning for them. So obviously the $50,000 of IRA distribution that you see there is not the only income that they have in retirement, because they have additional income that is coming in to them through Roth IRAs and Roth 401ks and personal insurance and retirement plan. There's a strategy that we use with our clients using PERP, using life insurance. For many of you on this call, if you truly understood the tax benefits of life insurance, it is by far one of the, if not the best retirement vehicles and strategies available in the marketplace. So these clients in the whole, at the end of the day, I'll tell you what they're generating in income altogether, and I think you're going to be fairly surprised. But in this situation, the clients are just pulling out $50,000 of taxable IRA income, which is reported as a 1099 as ordinary income. Now, when I take you to the tax map, you will notice that because all the other income that the clients are generating in retirement, only their $50,000 of IRA income is taxable to them. But I want to share with you a couple of things. Notice that you see there $50,000 of income, and the clients, these clients, because they're filing married filing jointly, they fall in the new 20% marginal tax bracket. Now, you'll say, well, Bert, how can that be? Because, you know, the tax liability, as you see here on the bottom, is $2,430 on a $50,000 off distribution, which is an effective tax rate of 4.86. So the big question is, well, how can these clients generate $50,000, take $50,000 out of their IRA? And if you know anything about IRAs and 401ks, when you put the money away in a 401k or an IRA or any type of pre-tax retirement plan, when you make the contributions, you do that on a pre-tax basis. The money grows tax deferred. And then when you pull it out, you have to pay taxes not only on your contributions, but also on the growth of those investments. In this situation, because we live in a progressive tax system, the more money you make, the higher the tax bracket will go. But you're only going to get taxed on that portion of your income that falls within that specific tax bracket. So if you notice here, because of the Tax Cuts and Jobs Act of 2017, which was signed by President Trump on December 20th of 2017, the 0% tax bracket has actually been expanded. So in this situation, up until the income of $26,500, these clients did not have to pay any income taxes whatsoever, and that is due primarily to the extension of the certain deductions and obviously exemptions and credits. And we'll get into another conversation along those lines in another webinar. But today, we're just going to stick to this exercise because I think you will find what I mean by this to be a very, very interesting concept. Now, once a client's pass $26,500, you will notice that the income jumps to the 10% marginal tax bracket. So between $26,750 and then along the line to about $45,500, that portion of income that fell between $26,750 and $45,500 will pay taxes at a 10% rate. And then only the income that falls between $46,000 and $12,000 will pay taxes at a 12% tax bracket or a marginal tax rate. So that is why, although the marginal tax bracket is 12%, the effective tax rate is only 4.86. So when I had this conversation with these clients and I said, look, how do you feel about paying $2,430? They say, you know, Bert, we don't have any problem with that because if I only pay, you know, 4.86% in taxes on a $50,000 of taxable income distribution, that's a win-win for me and my family. Especially since these clients are generating so much more money on a tax-free basis based on the planning that we have done for them in the past. But then again, I'm always skeptical because at the end of the day, I feel very strongly that the best and the number one tax bracket that all of us need to have in retirement is the 0% tax bracket. So the big question is, well, how do we get our clients to this 0% tax bracket? So here's what I did. I brought the clients in and we had a discussion. And you know, I gave them an additional scenario for them to consider. And I'm going to share that scenario with you now real quickly so you can get a feel for what we're trying to do and why I feel so strongly that when it comes to retirement, not all income is created equal. So I said to the clients, look, Mr. and Mrs. Client, what if you had an opportunity to start pulling money out of your Social Security benefits and not pay a single dollar of income tax? Because tomorrow is promised to no one. I mean, even though you may have longevity on your side of the ledger, you can get hit by a car, you can have a stroke, you could get cancer. You know, again, tomorrow is promised to no one. I have been in this industry 28 years, and I have delivered many death benefit claims on life insurance clients because of the fact that they suffered a premature death. So again, no one ever dies at the right time. But by the same token, I said to the clients, look, Mr. Client, what if I can maintain and give you the same $50,000 of income, but instead of you having to pay $2,430 of taxes, as you see here, you pay $0 in taxes, and your effective tax rate, instead of being 4.86%, it is 0%. How would that feel? And the client said, oh, wow, can you do this? And I said, absolutely. And not only that, I mean, think what an additional $2,430 can buy. It can make another car payment. You can put that money away into some savings. You can take an extra vacation. You can actually, if you're smart enough and you work with someone like me or someone that understands tax planning very well, you have the ability to take that money and enroll it to a Roth IRA and then have that money grow tax-free for the rest of your life. So you have many, many ideas. And what I did for these clients is I went ahead and reduced their distributions to $15,000, and I had them retire immediately. By retiring immediately, both of them were able to receive $35,000 of Social Security benefits, plus the $15,000 of IRA distribution. I was able to match the current $50,000 of income that they have. Now, you'll say this, well, Bert, wait a minute. You said that when you put money away in a qualified plan, you put the money in pre-tax, the money grows tax deferred, and then when you pull the money out, you have to pay taxes not only on the contributions, but also on the distributions. But here, these clients were able to take $15,000 out of their IRAs, and they didn't pay a single dollar of federal income tax. The reason for that, ladies and gentlemen, and on this call and on this webinar, is that I was able to offset those $15,000 of distributions by doing provisional income calculation planning and by being able to maximize the deductions, exemptions, and credits that these clients have in retirement in order to void any potential tax liability. And they have actually been able to divorce the IRS in retirement and have been able to do so legally. So this is a really, really good conversation. And the clients were really excited. I said, well, wait a minute, maybe perhaps we can get this a little bit better. I said to the clients, look, do you need any additional money? And they said, well, not really, Bert, because with the money that are these $50,000, the $15,000 from the IRAs and the $35,000 from the Social Security benefits, plus all the additional money that we're generating from our Roth IRAs, 401ks, and also our life insurance program that you set up for us years ago, we really don't need any more money at this point in time. I said, okay, well, that's fine, but let me ask you this. How much money do you think that we can continue to pay or to take out and distribute out of these IRAs that you have in place without having to pay any more in taxes and without actually having to pay a single dollar of taxes. So they were curious about that. So I said, well, let's go through this exercise. So I started to increase the distributions, as you can see there. I went to 17,000 of IRAs, still no tax liability. I went to 18,000, no tax liability. I went to $19,000, no tax liability either. 20,000, more of the same. $21,000, more of the same, no tax liability. $22,000, no tax liability whatsoever. Now, once I hit $23,000, I have a small tax liability of $66, as you see here. So I'm just going to scale it back $1,000. So here's the issue for the clients. Before, they were generating $50,000 of income, totally taxable at a 12% marginal tax rate and a tax liability of $2,430. Now, these same clients are generating $57,000 of income, an additional $7,000 of income, but actually net income is $9,430 because the clients didn't have to pay the $2,430 in taxes. So you have to add that as income kept in the household. So income kept in the household is an additional $9,430, and the tax liability is zero. So again, I asked the clients, well, do you need that additional $7,000 of income? And they said no. I said, well, what if you have the ability now to take that $7,000 of income that came out of the IRAs and roll that into a Roth IRA? See, the minute you put money into a Roth IRA, you have to be willing to pay the tax, but then the money grows tax deferred, and then you pull it out tax-free, down the line. And because they're Roth IRAs, you don't have to worry about the minimum distribution at age 70 and a half as you would in traditional retirement plans like IRAs or 401ks. So these clients can start putting a lot more money away into the Roth accounts and have the money grow tax-free, and they don't have to pull money out at age 70 and a half. So they can say, well, I'm going to start pulling money out of this account at age 75, age 77, age 80, age 85, or they just decide to leave that money there because upon their death, it will go to the survivor on a tax-free basis as well. So in this situation, we were able to pull an additional $7,000. Now think of it this way. I have been able to pull out, on behalf of these clients, $22,000 out of their IRA. The money went in pre-tax, it grew tax deferred, and I have been able to pull it out with no tax liability, tax-free, on behalf of these clients. So now they have tax-free or tax preferred when they put it in, tax deferred when the money grew, and then tax-free upon distribution. So they have been able to achieve a win-win-win, not only for themselves, but also for their families. See, that's where doing provisional income calculation comes into play. I will tell you what it takes to do provisional income calculation toward the end of this short webinar. Now, the clients were excited. They said, my gosh, Bert, when do we do this? Can we do this right away? And can I do this every single year? And the answer is yes. We're actually doing this every single year with these clients. But then I said to the clients, well, when we started this conversation, Mr. and Mrs. Morris, you did tell me that you really didn't have any problem whatsoever in paying that $2,430 because at the original $50,000 of IRA distribution, you were only in the 4.86 effective tax rate. You still feel that way? And they said, yes, we feel that way, but now we feel a lot better because we don't have to pay taxes. I said, well, let me kind of walk you through another exercise. How much more money could we take out of these IRAs to eventually get close to equal that tax liability that you would have had when you didn't start taking Social Security benefits and you were just using the $50,000 out of IRA distribution. So I said, how much more can we take out? And until such time that we're paying taxes on that distribution, but just pretty much to match to what we would have paid if we have never had this conversation. So I said, let's go through that exercise. So I started to continue to increase my distributions on the IRAs on behalf of these clients. And now obviously I'm up to $25,000 in IRA distributions. Now we have a tax liability of $368. I'll continue to go north on that distribution. I'm actually up to $30,000 of IRA distribution. And my tax liability is about $1,238. Let me keep going north, keep going up. I'm up to $33,000, up to $34,000, up to $35,000. So I'm about $2,214. So I'm just shy of the $2,430. Let me go one more thousand. So, okay, so we're pretty close now. Here's what we have been able to do, or what I have been able to share with these clients. They have the ability now to take up to $36,000 out of their IRA and pay $2,436 in taxes, compared to the $2,430 they would have had before they factor in their Social Security benefit. So yes, I did go over by $6, which is not a big deal. But the clients, look, now instead of having $50,000 of income, now they have income of $71,000, which is an additional $21,000 of income for pretty much the same tax liability that they would have had they stayed with the $50,000 of income distribution. Now the question is, well, what can we do with those $21,000? There's a lot of stuff that you can do. Again, you can take vacations, you can spend it, you can put into a savings account, you can do a Roth IRA if you want to, so you can shelter that money from taxes for the rest of your life. Clients have the ability to do Social Security planning, which is something that we actually did for these clients a few years ago, because most people don't do Social Security planning. And here's what I mean by that. When a husband and wife retired and they're receiving Social Security benefit, each of them is going to receive their own Social Security benefit. Upon the passing of the first person, whether it's a husband and the wife, now statistically speaking, the husbands are going to pass away first. The surviving spouse, whether it's a male or a female, will choose which one of the two Social Security benefits they will take. Now, in my situation, my wife, hasn't worked in many, many years. Her Social Security benefits are much, much lower than my Social Security benefits, especially because of the income that I have generated for many, many years. So if I were to die in retirement, my wife is going to immediately choose my Social Security distribution instead of hers. Now, the minute that she does that, her Social Security benefits go away. And what is happening with American families today is that when they get used to generating and maintaining their standard of living by using two Social Security benefits, and one of them were to pass away first, yes, the surviving spouse gets to pick the higher one, but they're going to lose one of them. So you have to do proper Social Security planning. In most of the time, what we do for our clients is we figure out exactly what the Social Security benefits are going to be in the future. And then we acquire enough guaranteed life insurance to make certain that on the passing of the first spouse at the first death, that the surviving spouse can now opt in and assume the higher Social Security benefit, and then that tax-free guaranteed death benefit that is paid to the surviving spouse can now be utilized to replace that foregone Social Security benefit that was left behind. Now, because of these clients now have an additional $21,000 of income available at very, very little tax liability, they can take a portion of that money, buy a guaranteed life insurance policy. So now here's what they're doing. They're buying a guaranteed life insurance policy with money that could have either been non-taxable or taxed very, very little. And then on top of that, the money that they're putting into the guaranteed life insurance policy is now growing tax deferred. They're going to be able to pull it out tax-free. Most important, the death benefit is federal income tax-free to the survivors. And in addition to that, because of the fact that people are living longer today, the cost of life insurance is cheaper today than it was 20, 25, 30, 35, 40 years ago. But on most important, the fact that people are living longer today doesn't mean they're going to be any healthier. So these clients now can buy guaranteed life insurance contracts that have guaranteed long-term care, chronic illness, critical illness riders available inside the contract. So if there's a need for long-term care, they can start to invade the death benefit of these life insurance contracts in order to pay for the additional expense of either adult care facility, home health care, hospice care, a nursing home, or whatever that may be. So you have to, when you do retirement distribution planning, you have to take into consideration all of these other things that play such a major role in making certain that you enjoy first of all, a successful retirement life, but most of all, a tax-free retirement life. Again, obviously, this is a webinar that we feel that is very, very important for us to cover, and we do these with our clients every single week, because we want to make certain that we do it the right way for them from a business perspective. The other thing that is critical to understand, I'm going to go ahead and start my video, and I'm going to stop sharing my desktop at this point in time. The other thing that is very critical to understand as you consider all of these retirement plans is that also, you know, whenever you have a pool of retirement assets, how are you going to start taking money out of that pool? Where's the money going to be invested? You know, many of my clients, one of the calculations that we do is we take a look at what their fixed expenses are. And then we take those fixed expenses, including Medicare, because Medicare does have a cost, and the more money that you generate, the worse off you're going to be as far as the cost of Medicare is concerned. And we want to make certain that we can invest in products that will guarantee that our clients will never, ever be able to outlive their assets and not be able to pay their expenses in retirement from a business perspective, which is something very, very critical for everyone that I deal with. The vast majority of my clients are either anywhere from 5 to 10 years away from retirement, or they're already in retirement. What I can tell you is just about every one of my clients that are currently in retirement have never argued the fact that they're paying a lot less in taxes today, not because their tax liability was going to be lower, but because of all the tax planning that we did before they reached retirement age. Think of retirement as if you were climbing a mountain. If you happen to be a mountain climber and someone were to ask you, you know, what is the goal of every mountain climber, especially one that may want to climb, let's say, Mount Everest, for an example, and they'll say, well, it's to get to the top or to get to the summit. I would argue totally different. The goal of every mountain climber is not only to get to the top of the mountain, but also to make it down safely. Because, by the way, and this is all statistics that you can look up for yourself, over 70% of all the people that have died on Mount Everest have not died on the way up. They have actually died on the way down, which is something very, very critical, because if getting old is bad, getting old and having no money whatsoever is even worse. And when it comes to retirement, it's all about the distribution rate. It's not about the accumulation rate. So again, I hope that you have all heard this webinar, that you have enjoyed it, that I have been able to bring you some education, because at Cambridge, we feel very strongly that information without education always leads to failure. And again, I want to part by saying something that I say in every single podcast and every single webinar that I do, not only for new people that want to hear our story, but also for our clients on a regular basis, and is that my goal in life from a financial perspective is to help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, I want to wish you all the very best. If some of you want to reach out to me personally, please feel free to do so. You could either call my offices at 786-766-1042. You can also reach out to me via email at Bert, B-E-R-T, .Salazar, S-A-L-A-Z-A-R, at Cambridge, F as in Frank, P as in Paul, LLC.com. And I'll be happy to schedule a 20-minute video conference call at no cost or obligation, and at least I can answer any type of questions that you may have. And if you decide to work with us, we would put together our tax-preferred, customized retirement blueprint, which is the premier customized retirement blueprint in the financial services and retirement interest industry today. So again, thank you and have a wonderful, wonderful day.